Mr. Soros, thank you for having us here today.
Fair pleasure.
Appreciate it. Your latest book is the Crash of 2008 and What It Means. In 2007, you warned that there was a potential risk of the financial system collapsing. We've essentially seen that. And now it seems like there's an emerging view that the worst of the crisis is over. Do you agree with that?
Well, certainly the crisis has happened. What you have to realize that the financial system actually collapsed on September 15, when Lehman Brothers went into bankruptcy. The effect was a total collapse, which required the authorities to put the system on artificial life support, which is where it is now.
So we're still on life support at this point.
This is where we are, and this has had a unintended negative consequence for the rest of the world that were not in a position to put their systems, their banking systems, on artificial life support. And the G20 meeting was meant to provide them with a lifeline.
And you think that they were successful at doing that? You said
They have
after
done
the
it.
meeting, yeah.
They have done quite a bit. So it was. I would say it was a success. Particularly, I'm very keen on the issue of the special drawing rights, which effectively puts buying power into the hands of the least developed world,
Right.
and the ones who are worst affected.
So if we're still on life support, how high is the risk that we could have a true depression, that the downturn could accelerate further from here?
The real danger of collapse has passed. So we are past that emergency situation.
Right.
We did not succeed in recapitalizing the banks to the point where they can lend freely to business. They still have to earn their way out of the hole, and that's going to last a long time.
Interesting. So it sounds like you don't think that the steps that policymakers have taken, to date at least, have been sufficient or the right steps to resolve the banking crisis.
That's right. It will linger because we're keeping the banks alive. But this talk of zombie banks,
right.
Unfortunately, that is where we are now. The banks are alive, but they know that they've got assets that are depreciating, and they have to charge extra. So they're actually, instead of providing lifeblood of credit, they are effectively drawing the lifeblood of activity, of profit, to themselves, to dig themselves out of a hole. And that is the current situation.
So how great of an effect, what is your outlook for the U.S. economy? There's a lot of people talking about that we're going to be back to positive growth by the end of this year or early next year. Do you share that view?
Well, you know, it depends a great deal on what the authorities do. Also, how far and how steep and how fast the economy falls, because if it falls very far, then you will have a rebound from that low. I describe the recovery as an inverted square root sign.
An inverted square root sign.
Which, you know, well, the square root goes like this,
right.
But an inverted square root goes like this.
Okay, so a little shallow bounce and then flattened out.
Yes.
Right. Well, so what do you see as the market impact of that? Because obviously in the last month or so, the markets have had a strong rally. There's a sense that they are going to help the banks, and it doesn't sound like you think that's a sustainable move.
No, I'm afraid it isn't. I mean, it may carry further. I think the G20 actually was the first time that the authorities did anticipate an impending crisis in the rest of the world and did something to forestall it. So that's you could say that there they were ahead of the curve. So they were rewarded by a rally, which extended the rally. But now we will be facing reality.
And reality, does that mean we're going back to test those lows that we saw in early March to beat those, perhaps? For the stock market?
Look, I'm not very good at predicting markets, so I wouldn't rescue.
You're just very good. You've just gotten lucky all these years. Is that?